Alors, bonjour tout le monde. Good morning, everyone. Welcome to the Bank of Canada and this morning's press conference about today's interest rate announcement and monetary policy report. Comme d'habitude, le gouverneur Macklem va prononcer sa déclaration préliminaire. Après, nous allons tourner aux vos questions. After his opening remarks, Governor Macklem and Senior Deputy Governor Carolyn Rogers will be happy to take your questions until about 11:15 or so. Alors, Monsieur le Gouverneur, la parole est à vous.
Thank you, Paul, and good morning, everyone. We are very pleased to be here, or I am very pleased to be here, with Senior Deputy Governor Carolyn Rogers to discuss our decision and our new monetary policy report. Today, we lowered our policy interest rate by 25 basis points. This is our sixth consecutive decrease and brings the policy rate to 3%. We also announced our plan to complete the normalization of our balance sheet, ending quantitative tightening. The bank will restart asset purchases in early March, beginning gradually so that its balance sheet stabilizes this year and then begins to grow modestly in line with economic growth. We have three main messages this morning. First, inflation has been close to the 2% target since last summer. Monetary policy has worked to restore price stability. Second, lower interest rates are boosting household spending and economic activity is picking up. But third, the potential for a trade conflict triggered by new U.S. tariffs on Canadian exports is a major uncertainty. This could be very disruptive to the Canadian economy and is clouding the economic outlook. Aujourd'hui, on a abaissé le taux directeur de 25 points de base. Cette sixième baisse consécutive fait passer le taux à 3%. On a aussi annoncé notre plan pour finir de normaliser notre bilan en mettre fin au resserrement quantitatif. La banque va recommencer à acheter des actifs au début de mars. Les achats seront graduels au départ pour que son bilan se stabilise cette année et croissent ensuite modestement au rythme de la croissance de l'économie. On a trois grands messages ce matin. Premièrement, l'inflation est près de la cible de 2% depuis l'été dernier. La politique monétaire a permis de rétablir la stabilité des prix. Deuxièmement, les taux d'intérêt plus bas stimulent les dépenses des ménages et l'activité économique se redresse. Mais, troisièmement, la possibilité d'un conflit commercial déclenché par de nouveaux droits de douane américains est une source majeure d'incertitude. Ça pourrait beaucoup perturber l'économie canadienne et brouiller les perspectives. Since the scope and duration of a possible trade conflict are impossible to predict, the NPR projection we published today provides a baseline forecast in the absence of tariffs. We also provide some discussion of the potential consequences of a major trade conflict. Let me expand on the first two messages before turning to the threat of tariffs. First, inflation. A year ago, inflation was 3%. Short-term expectations were still elevated, and inflationary pressures were broader than normal. In recent months, inflation has remained close to 2%. Business and consumer expectations have largely normalized, and there is no longer evidence of broad-based inflationary pressures. Shelter price inflation remains elevated, but is gradually coming down. While we expect some volatility in CPI inflation due to temporary tax measures, our forecast is that inflation will remain close to the 2% target over the next 2 years. Second, growth. There are signs economic activity is gaining momentum as past interest rate cuts work their way through the economy. Lower borrowing costs are boosting activity in the housing market, as well as spending on big-ticket items like automobiles. The pickup in household spending is starting to broaden to other consumer items and is projected to strengthen further. Business investment has been weak, but is forecast to increase gradually. And the outlook for exports is being supported by new export capacity for oil and gas. Employment has strengthened in recent months, but with job creation having lagged labor force growth for more than a year, the labor market remains soft. The unemployment rate was 6.7% in December, and wage pressures, which have proven sticky, are showing some signs of easing. The bank forecasts GDP growth will strengthen from 1.3% in 2024 to 1.8% in 2025 and 2026. Growth in GDP per person is projected to pick up as lower interest rates and rising incomes support spending. The projected increase in overall GDP growth is more modest than it was in October, largely due to lower population growth that reflects new federal immigration policies. There are risks around the outlook, and Governing Council is equally concerned about inflation rising above 2% or falling below it. Absent the threat of tariffs, the risks to the inflation outlook are roughly balanced. Let me now turn to the question of tariffs. U.S. trade policy is a major source of uncertainty. There are many possible scenarios. There's a lot we don't know. We don't know what new tariffs will be imposed, when, or how long they will last. We don't know the scope of retaliatory measures or what fiscal supports will be provided. And even when we know more about what is going to happen, I do need to be clear, it's still going to be difficult to be precise about the economic impacts because we have little historical experience with tariff changes of the magnitude that the U.S. is contemplating. Nevertheless, some things are clear. A long-lasting and broad-based trade conflict would badly hurt economic activity in Canada. At the same time, the higher cost of imported goods will put direct upward pressure on inflation. The magnitude and timing of the impacts on output and inflation will depend importantly on how businesses and households in the United States and Canada adjust to higher import prices. Malheureusement, les droits de douane rendent les économies moins efficaces. Ils font baisser la production et les revenus. La politique monétaire ne peut pas contrebalancer ces effets, mais on peut aider l'économie à s'ajuster. Puisque l'inflation est revenue autour de la cible de 2%, on est mieux placé pour être une source de stabilité économique. Mais on ne peut pas contrer une production plus basse et une inflation plus élevée en même temps, avec comme seul instrument de la politique monétaire le taux directeur. Pour déterminer notre réponse de politique monétaire, on doit bien évaluer et mettre en balance deux types de pressions sur l'inflation. Les pressions à la baisse découlant de la faiblesse de l'économie et les pressions à la hausse attribuables au prix plus élevé des entrants et aux perturbations des chaînes d'approvisionnement. Unfortunately, tariffs mean economies simply work less efficiently. We produce and earn less without tariffs. Monetary policy cannot offset this. What we can do is help the economy adjust. With inflation back around the 2% target, we are better positioned to be a source of economic stability. However, with a single instrument, our policy interest rate, we can't lean against weaker output and higher inflation at the same time. As we consider our monetary policy response, we will need to carefully assess the downward pressure on inflation from weakness in the economy and weigh that against the upward pressure on inflation from higher input prices and supply chain disruptions. So let me tell you what we're doing in preparation. In recent years, we have invested in better information on supply chains, trade links, and the connections between sectors. And this is helping us analyze the effects of supply disruptions, including tariffs. We've begun assessing the possible consequences of different tariff scenarios, and we present an example in the Monetary Policy Report. We are stepping up our outreach activities across the country to hear directly from those affected by trade uncertainty. This includes augmenting our surveys of business and consumers to better understand how trade uncertainty is affecting their decisions and how they would cope in the event of a trade conflict. We will update you on our analysis and assessments as developments unfold. Having restored low inflation and reduced interest rates substantially, monetary policy is better positioned to help the economy adjust to new developments. As always, the bank will be guided by our monetary policy framework and our commitment to maintain price stability over time. With that, the Senior Deputy Governor and I would be very pleased to take your questions.
Okay, thank you, Governor. And we will go to questions now, starting with the roughly dozen or so reporters I have here in the room in Ottawa, after which we'll go to those who have joined us remotely. As usual, I'll ask you to please limit yourself to one question so that every media outlet does get a chance to ask. And if I forget to do so, please state your name and affiliation. Please remember to use the microphone here in the room to ask your question. Et avant de poser votre question, veuillez vous identifier si je ne l'ai pas fait. Et comme du jour, libre à vous de poser vos questions, soit en anglais, soit en français. So let's start here in Ottawa. I'm going to call on Paul Vieira from the Wall Street Journal.
Governor, the decision talked about how the Canadian dollar is depreciated materially. Does this indicate that the so-called limits of policy divergence have been reached and BOC officials are worried about its potential impact on inflation? And would a weaker currency limit the Bank of Canada's ability to provide support in a trade conflict?
Okay, you packed a lot in there, Paul. And I know you know this, but I do want to begin by reminding everybody that we don't target the exchange rate. The flexible exchange rate is an integral part of our monetary policy framework that allows us to gear monetary policy in Canada to the specific situation in Canada. So if you're asking us, has the movement in the Canada-U.S. exchange rate constrained our monetary policy decisions to this point? The answer is no. We've cut our policy interest rate 6 consecutive times now, bringing the rate down from 5% to 3%, 200 basis points. That is having some impact on the Canadian dollar, but as we discuss actually at some length in the monetary policy report, that effect is relatively modest. The depreciation we've seen, the recent depreciation we've seen in the Canadian dollar has been more driven, in our view, by trade uncertainty, and particularly President Trump's threats to impose 25% tariffs on Canadian exports. You can see that from a number of things, but in particular, if you look at the timing of the depreciation, it follows very closely on President Trump's threats. This is a more material move in the Canadian dollar. I mean, if you go back to October, Canadian dollar was 74 cents. It's now been fluctuating. It's now sort of 69 to 70. So, look, that is a material depreciation, and it will start to have some impacts. Depreciation makes our exports more competitive. Of course, the threats of tariffs will make them much less competitive. But it also has some other impacts. It means that everything we import will, the cost of things we import, it will be higher. And you will start to see that relatively quickly on things like fresh fruit and vegetables, which obviously it's winter in Canada. We import a lot of those from the United States. That'll get passed through pretty quickly. More generally, pass-through tends to be pretty slow. It tends to evolve over time, but that is something that we have built into the outlook that you see today. The other implication of a weaker Canadian dollar is that any intermediate inputs, so for example, machinery and equipment, investments Canadian companies make, buy equipment from the United States, that becomes more expensive. That will hurt our investment. So those things, we've assumed a 70-cent dollar in the projection that we published today, and the depreciation we've seen so far is built into that. Going forward, look, there's no doubt the exchange rate is responding to the threat of tariffs, and I think it's reasonable to expect that as developments unfold, that will be financial markets. We'll take that on board. It'll be reflected, and that is something that we will have to build in to our outlook. And obviously, the bigger the movements in the Canadian dollar, the more we're going to have to take those into account as we set policy going forward.
Okay, we'll go now to Promit Mukherjee from Thomson Reuters.
Thanks, Paul. Good morning, Governor. So you have said that in the event of a 25% tariff and a possible retaliation from Canada, monetary policy might not be able to offset that. But do you think quantitative easing will be one of the tools that you can resort to?
So I think what you're saying is, your question is, what's going to happen to interest rates if 25% tariffs are imposed?
No, not actually. I wanted to understand that is quantitative easing one of the tools?
Oh, quantitative easing. Sorry, I missed that part. Okay. We're a long way from needing quantitative easing. I mean, our policy rate is at 3%. We recently published a review of our use of our extraordinary tools during COVID, and what we concluded was that the bar for using quantitative easing in Canada has always been very high. In fact, we've only used it once when we had a once in a 100-year pandemic. And the bar for using quantitative easing should remain very high going forward. We're a long way from that, and we have plenty of room with our policy rate.
Okay, next I'm going to go to Kevin Carmichael of The Logic. I'm being told that the mics here in the room aren't picking up very well on the webcast, so please do your best to focus into the microphone when you're asking your questions. Kevin.
Good morning. To what extent are the threat of tariffs baked into what you've done today, the policy decision and the forecast? I know you've laid out in excellent detail about how difficult it is to anticipate what might be coming, but did you try to factor in the tariff threat in any sort of way in what you've done today?
Well, I'll answer that in two parts. With respect to the forecast that we published in the Monetary Policy Report, I think we're very clear. It assumes that there are no new tariffs. It does include a modest effect of the uncertainty being created by the threat of tariffs, particularly on investment. But effectively, in the projection, we're assuming that the threat of tariffs, it's a rather nice scenario. The threat of tariffs sort of dissipates, that uncertainty goes away, and we don't have to deal with it. We go on in the second part, of course, at looking at a scenario where there are broad-based and actually permanent new tariffs to give some idea of what the impact would be. But that is not a forecast. Coming to the decision itself, obviously the forecast is an important input in the decision, but obviously the risks around it also factor into the decision. We've got to look at the whole landscape. So, I mean, if you start with the facts on the ground, what's going on in the economy, what you see is that inflation has remained pretty close to 2% since last summer. And if you look at all our indicators of inflation, underlying inflation looks like it's running around 2%. We're not seeing broad-based inflationary pressures. Secondly, the economy is still in excess supply. Labor market's soft, unemployment rate 6.7%. That softness in the economy, that slack in the economy, that is putting downward pressure on inflation. We want to see growth pick up, take up that slack to keep inflation close to 2%. And we are starting to see that. Growth is picking up, and we want to see that pick up sustained to absorb that slack. So, I think those things suggested that, a further cut made some sense. Then you look out the window, and the threat of tariffs is there, and there's no doubt, that weighed on our decision. The more we can get the economy on a solid footing before it faces new tariffs, the better. And from that risk management perspective, I think that reinforced the decision to cut the policy rate by 25 basis points.
Okay, I gather we're going to have mics being handed out, and Jordan Gowling, Financial Post, you're next, please.
Morning, Governor. If you only have the policy rate, can you just explain to Canadians what the Bank of Canada's role is in a trade war scenario?
Well, obviously, we need to understand what a trade war would do to the Canadian economy. That's the first thing we need to do. We need to analyze it and assess it. Obviously, there's a lot of things we don't know right now. We don't know what new tariffs will be imposed, when, for how long. We don't know what retaliatory measures will be taken. We don't know what any fiscal measures will be taken in response. But there are some things that are pretty clear. In the case of a protracted, significant trade conflict, it would badly hurt economic activity in Canada. Economic activity would be lower. Growth would be negative. Growth would be lower for a period, and then it would eventually come back to where it was, but the whole path of the economy would be lower. Secondly, import prices will be higher, supply chain disruptions, both those things together will put some upward pressure on inflation. So I think as you were getting at, look, this is a complex shock for monetary policy because growth will be weaker, inflation will be higher. So, and yes, we can't lean against weaker growth and higher inflation at the same time. So, what are we going to be doing? Well, we're going to be assessing the relative weight of those two, and if the weakness on the economy that comes through as a result of tariffs and the downward pressure that's putting on inflation comes faster and is bigger than the upward pressure, then monetary policy, I expect, will be focusing more on supporting growth. On the other hand, if the inflationary pressures come through faster and are bigger, monetary policy is going to have to be more focused on guarding against persistent inflation. What are we doing right now? We're running different scenarios. We presented an example of one scenario. It's a pretty severe scenario in the monetary policy report. We're certainly looking at others, and we're stepping up our outreach activities to hear directly from Canadians and Canadian businesses. How are they coping with this uncertainty? How would they react to a tariff, a big change in tariffs? And look, those will be we're going to use that to make those decisions if monetary policy is faced with taking decisions during a trade war. I will just sort of close off by a couple other emphasizing a couple of things. Monetary policy cannot offset the economic consequences of a protracted trade conflict. The reality is the economy is going to work less efficiently. Canada is going to produce less. It's going to earn less. Monetary policy can't change that. It cannot offset it. What it can do is it can help the economy adjust to that and to try to be a source of stability through that adjustment. So the adjustment is less unpleasant than it otherwise would be. The other thing I'll say is that we have got inflation back down around 2%. We've lowered interest rates substantially. Growth is picking up. So the economy is in a better place. Monetary policy is better positioned to be able to react to developments and be that source of stability.
Okay, next I've got Alicia Sikirska from Yahoo Finance. Go ahead, please, Alicia.
Thank you so much for taking our questions. Governor, does the bank see potential tariffs as a one-time increase?
Sorry, can you talk a little closer to the mic?
Does the bank see potential tariffs as a one-time increase in price levels on the impact on inflation? And how concerned are you about the impact potential tariffs could have on inflation expectations and the risk that they become unmoored?
Well, if we do our job properly, yes, it's a one-time increase in the price level. That's exactly one of the key things we're going to focus on. So, yes, a big increase in tariffs will have an initial effect on prices. It'll push them up. And that, that will push inflation up. And actually, monetary policy, given the lags in monetary policy, there's not much we can do about that. What we don't want to see, though, is we don't want to see that initial price level increase start to feed through broadly to other prices and wages and then become persistent inflation. So that is, a key thing that we will be focused on in preventing inflation will go up, but we want to make sure it comes back down to the 2%. We don't, this shock does not create persistently higher inflation. That won't be good for Canadians.
Okay, next I've got Greg Quinn from Market News.
Good morning. I'd like to turn backwards a bit to the bank's recent report on its pandemic actions. The staff report talked about bank communications, including the communications about keeping interest rates near zero. So I'd like to ask you about this comment in the report. It said, central banks often adjust or simplify the wording, particularly to make it clear and more accessible. Communication is often further simplified or interpreted by the media and people providing financial advice. This can very easily lead to the public understanding or interpreting the guidance in ways the central bank does not intend. When a central bank does not follow what it has perceived to have said, this can be seen as a broken promise. Did you break a promise to Canadians? Did journalists and financial experts mislead Canadians?
Look, I think we learned from this that forward guidance has its uses, but it has to be used very carefully. And with the benefit of hindsight, in retrospect, we should have been clear about sort of the exit clauses, the conditions under which this would hold. And I think, yes, I think in the process of communicating it, those conditions weren't as clear as they should have been.
Okay, I'm going to stay down here and go to Nick Murray from Canadian Press, please.
Hi, good morning, Governor. I think you've talked at length about the decision behind the rate cut, but from a contrarian point of view, there were some economists who were suggesting perhaps a hold to the interest rate at this point, considering some of the underlying inflation numbers that we saw from CPI. Some economists said they were warming when you remove the variable of the GST holiday, and also in light of what the Bank of Canada said before about taking a more moderate approach to rate cuts. And so I'm just wondering kind of what discussions and what considerations went into perhaps holding the rate and why that wasn't the case at this point.
Well, maybe I'll say a couple of things and ask the Senior Deputy Governor, since she was also part of the conversations. We said we would be considering further rate cuts, and we said we'd probably take a more gradual approach to monetary policy. So we did consider more rate cuts. We decided to do one, and it was more gradual. We cut 25 instead of 50. Maybe you want to comment a little bit on some of the details in the inflation numbers and.
Sure. You're talking about some of the core measures, and yeah, I mean, the way we use the core measures is really to gauge kind of what we always call underlying inflation. It's kind of the momentum to inflation, the direction it's going, and there's a whole basket of things we look at. And at any given time, depending on what's going on in the economy and how those particular measures are calculated, any one can be a more helpful signal than other ones. So, I mean, we looked at the core measures. They're a little bit above headline inflation. We kind of took them apart to look at why that result was coming out. There's some particularities, particularly about TRIM and how it's calculated, that led us to sort of not put a lot of weight on that as a signal of underlying inflation at this point in time. So, when you look on balance, I mean, really the chart that we think is the most helpful to helping us understand where inflation is going right now is the heat map, chart 9. That really says it all, I think, about inflation right now. So.
Okay, I'm going to go to the other side of the room and call on Mark Rendell for the Globe and Mail, please.
Thank you for taking the question. You've mentioned a couple of times how monetary policy isn't particularly well equipped to respond to a kind of stagflation shock or price level shock like we're seeing with a tariff. Does that mean that fiscal policy needs to take the leading role in response to a trade war? And if so, are there more and less effective measures that provincial and the federal government could take in this scenario?
Well, Mark, I know you know this, but I have to say it again. Fiscal policy is the responsibility and the purview of elected governments. The Bank of Canada, we have a big job. Monetary policy, we focus on that. We leave fiscal policy to them. Look, clearly, just as we're looking at different scenarios and thinking about what's coming, so are governments across the country, whether that's retaliatory, possible retaliatory measures to tariffs or possible fiscal measures. The only thing I will say is, monetary policy by its very nature is a very blunt instrument. There is one interest rate for the whole country, for every sector, for every Canadian, and in some sense, that's what makes monetary policy quite effective, but it also means that monetary policy can't differentiate between sectors or industries. It's the same policy rate for everybody. Fiscal policy can be more targeted, and I think that's what you were getting at. Again, those decisions are decisions of elected governments, and we will leave it to them.
OK, la prochaine question vient de Olivier Ferramboissé du réseau TVA.
Bonjour à vous deux, merci de prendre nos questions. Les marchés s'attendent à ce que la Fed maintienne son taux cet après-midi. L'écart s'agrandirait donc avec le taux canadien. Vous avez dit à plusieurs reprises que vous aviez une marge de manœuvre avant que l'écart ait un impact trop important sur la valeur du dollar canadien. Le dollar est déjà affaibli par l'incertitude d'une guerre commerciale. Êtes-vous arrivé au bout de cette marge de manœuvre-là?
Donc, nous avons discuté dans le revue sur la politique monétaire les raisons pourquoi on a vu la dépréciation de taux d'échange canadien. Et c'est vrai que le fait que nous avons abaissé de manière importante, substantielle, notre taux directeur est un facteur pour cette dépréciation. Mais notre analyse suggère que l'effet de l'écart des taux d'intérêt au Canada et aux États-Unis n'est pas le facteur le plus important. Cet effet est relativement modeste. L'effet plus important, c'est l'incertitude à cause des droits de douane. Si vous regardez le timing du changement de taux de change, ils sont liés les enjeux de président Trump sur les droits de douane. En termes de qu'est-ce qu'on voit, donc, comme j'ai mentionné, le fait que le dollar a déprécié de à peu près 4 sous depuis octobre, c'est maintenant une dépréciation matériaux. C'est pas très petit, c'est pas très grand, mais c'est pas très petit. Et donc, ça va commencer à avoir des effets. Ça va rendre notre exportation plus compétitive, mais les droits de douane va dans l'autre direction. Mais il y a les autres effets. Les prix des importations vont être plus hauts. Et surtout pour les aliments, par exemple, ça peut être un effet assez vite. Pour la plupart des biens, cette pass-through va prendre du temps, dont l'effet sur l'inflation, ce n'est pas très grand. Mais c'est quelque chose que nous avons tient en compte dans notre analyse, notre prévision. En regardant le futur, quand il n'y a plus d'informations au sujet des droits de douane, j'anticipe que les marchés financiers vont s'ajuster, comme toujours. Et si le dollar déprécie plus, ces effets vont être encore plus importants et on devrait prendre encore plus de ça dans notre analyse. Donc, je vais juste finir de souligner qu'on ne cible pas le taux d'échange. Nous avons un taux d'échange flexible et le fait que le taux d'échange est flexible, c'est un aspect important de notre cadre de politique monétaire. Ça nous laisse au Banque du Canada à gérer la politique monétaire pour les besoins de l'économie canadienne.
Okay, I'll come back to this side of the room for Mackenzie Gray from Global, please.
Hi there, Governor. You mentioned before that the scenario that presented in the NPR today is a very severe one, but I'd just like to get some kind of clarity on what your base case assessment is. If the 25% tariffs come in, is it the bank's feeling that there will be a recession and that inflation will go up at the same time?
Well, yeah, so just to underline, this is, the scenario we chose is a severe scenario. It's a 25%, so the U.S. puts 25% tariffs on every country, not just Canada, every country. Every country responds one for one with 25% tariffs on the U.S., and this is permanent. It's not, sort of a first shot to a subsequent negotiation. It's permanent. So it is a very severe scenario. What it shows is, we were really trying to show two things. The first thing is that, yes, this would have a severe effect on the Canadian economy. What you see in most of those simulations is growth in year one after tariffs, sort of 2.5% to 3% lower than it otherwise would have been in the first year. So, if you thought growth was going to be 2%, if you take 2.5% off 2, you've got a negative number. So yes, people would call that a recession. The second thing, though, I want to stress is that the simulation, this scenario and the various simulations were also designed to show that exactly what happens is quite sensitive to numbers. Getting a little technical, they're sort of parameters in a model, but what are these parameters reflecting? Well, these parameters are reflecting, how would Americans and Canadians respond to these tariffs? So just to give you a couple of examples, if you're an American and Canada, and so, the U.S. tariffs actually are a tax on Americans. They actually pay them. So anything they import from Canada becomes more expensive. So the question is, how do they respond to that? Do they just decide, I'll pay more, or do they go and do they find another supplier, maybe a domestic American supplier, or maybe they find an import from another country that isn't subject to tariffs, although in our simulation they can't do that because the U.S. put it on everybody. So, how do they respond? Similarly, when you look at Canadian importers, if we retaliate now, the import prices will be higher. Okay, well, who pays that import price? Does the importer decide to take that on their margin, or do they decide to pass it through to the consumer? How quickly do they do that? So there are a number of things, and as I said, we don't have a lot of good historical examples where we've had tariff shocks of this magnitude. So it's hard, we can't just go and estimate what's happened over history. So we're trying to show that, look, this would have a very material effect, would have a very severe effect on economic activity, but exactly how quickly, how big, how people react, what the implications are for inflation, there is a certain zone of uncertainty. And so, we're going to be working to try to narrow down that uncertainty as we move forward.
Okay, I've got 2 left here in the room and then 3 on the phones. Mike Lakacher from CTV, you are next, please.
Thank you. You started to ask, or preemptively basically ask yourself a question, so I'm going to put it back to you. What would happen to interest rates if there are tariffs?
Well, actually, I think I actually largely answered that question when I responded to Jordan. But look, I'll be very blunt. I can't give you a definitive answer to that question today because there's a lot of things we don't know. But what I can say is that we will do everything we can to be a source of stability. And as I outlined in the response earlier, this is a complex shock for monetary policy because growth goes down and inflation goes up. And we can't lean against lower growth and higher inflation at the same time. So we're going to have to weigh, which one's bigger, and we also have to look at the timing. Which affects bigger in what time period, and how do we do the best job we can to adjust interest rates to be a source of stability. And what happens to interest rates will really, what I think we'll be looking at is the weakness in the economy and the downward pressure that's putting on inflation, is that bigger than the upward pressure coming on inflation? And if that's the case, monetary policy can be more focused on supporting growth. On the other hand, if the inflationary consequences come through quicker and are bigger, monetary policy is going to have to be more focused on guarding against ongoing inflation. As I said, we are upping our outreach to Canadians to try to understand exactly how they're going to cope with new tariffs if they come in. And just to underline something I said before, monetary policy can't offset the effects of higher tariffs. Economic activity will be lower. We'll be producing less in Canada. We will be earning less. What it can do is sort of smooth that adjustment so it's less abrupt than it otherwise would be. And we will certainly do everything we can to be a source of stability.
Okay, our last question in the room, Randy Thandong-Knight from Bloomberg.
Hi, Governor. How should we interpret your decision to remove any rate guidance from your policy statement today?
Well, I think the answer to that's pretty simple. There's a lot of uncertainty out there, and it just didn't seem very useful to provide guidance. I think we've been pretty clear. Here's how we see the economy without tariffs. We don't know what the U.S. is going to do, and even when we do know more, we're going to have to do some more work to figure out exactly how that's going to play out through the economy. So, didn't seem very useful to provide guidance.
Okay, that's it for Ottawa. We're going to go to the phones now. I'm just going to remind people, come off mute only to ask your question. Go back on mute as soon as you finish so we can all hear the question. We've got 3 folks and we're running out of time, so let's get right to Max Sato from Mace News, please.
Thank you, Paul. Paul, good morning, sir. Ma'am, my question is for both of you. We saw a brief moment of a CPI drop from a year earlier at the start of the pandemic, and back in the late 1990s, Canada had a period of disinflation, and at that time, the Bank of Canada under Governor Thiessen cut interest rates, and I remember inflation quickly moved back from disinflation. And I understand you're more concerned about inflation caused by trade wars, but looking beyond that, is it still possible for the Canadian economy to face disinflation or deflation again? And how would you prevent that sort of situation? How would you respond if it ever happens? Thank you.
Well, I'll be very brief and ask the Senior Deputy Governor to chime in. I mean, look, our job is to maintain price stability. And our focus is making sure we don't have inflation that's well above our 2% target, or we don't have inflation that's well below the 2% target, and certainly not deflation. That's that's going to be our focus through, through the possibility of a big tariff shock. And I think I've been pretty clear. We've got to really understand everything that's going on in the economy to do that job. But I don't know if you can add anything.
Tough to add to that. The scenarios that we presented in the NPR are just that. They're meant to help you understand how we're thinking about the different effects on the economy that could come as a result of these these threatened tariffs, but they're not a crystal ball. They're models. They'll give us a sense of the different decisions that we're likely to face, but we'll have to face them at the time.
Okay, next is Rob McClister from Mortgage Logic News, please. Rob.
Good morning. Thank you for the great scenarios in NPR today. It's argued that tariffs provide a one-time boost to price levels. But 3 or 4 years ago, it was also said that COVID-related inflation would be everyone's favorite word, transitory. 1-year inflation expectations then surged almost 5 percentage points in 19 months. Would you agree that recent history seems to support the fact that one-time price surges and support measures can evolve into spikes in inflation expectations?
I mean, this is similar to the question we had earlier, right? That is exactly the scenario we would want to guard against, Rob. So initially, tariffs present a one-time price increase, but they can reverberate, just like we saw things reverberate in COVID. So that's exactly the scenario that we would be wanting to guard against, and why we would need to react if inflation takes off. If the inflation forces are stronger than the downward forces on growth, then it seems clear what we would need to do.
And finally, we have Anis Haydardi from CBC. Go ahead, please, Anis.
Hi there. So given that you have told us that, monetary policy cannot really do much in these cases, and we know that Donald Trump has said repeatedly, or at least his administration, that February 1st, Saturday, is the day something is happening. What are you folks going to be doing on Saturday morning or Saturday afternoon, and what comes next?
Well, I will be watching the news very closely, as I imagine most people in this room will. Look, I think as we know more, we have more clarity of what's going to happen, we can start to, build that more into our analysis. And look, we're going to have to take our decisions in real time as developments unfold. What I can tell you is that, look, if there are major developments, if there are big changes, we will update you on our analysis. We will keep you informed of how we think, how we see things evolving, and what's on our mind as we're all faced with managing through this.
And that concludes today's press conference. Thanks to the Governor, Senior Deputy Governor, and all of you for joining us. We'll see you next time.
Thank you very much.